going to, before we do the training that we have assigned for you, we're going to kind of talk a little bit about the point file when we are adding borrowers, and then in regards to the proposed monthly payments. So let me see. Let me start sharing my screen. Can you see my screen?
Yes.
Okay. So when we're doing the point file and we are adding this proposed monthly payment here for the homeowners insurance, I want to recap Gia's email. For homeowners insurance, for single family homes, it's going to be 0.35. For condos, it's going to be 0.25. So this property here itself is a condominium. So when we click on here, this should be locked so that this part is grayed out, but the rate you can change.
Okay.
So if it's for single families, or if you are unsure of what property type it is, always go with the higher, which is going to be 0.35, because that's going to change this monthly payment at a higher payment. And again, it's a DTI, like it affects the DTI. So always go with the higher one, so that way, if we can qualify with the higher, then the lower one will work.
Right. Yeah. So 0.35 for single family residence and 0.25 for condos, correct?
Correct. Okay. So we know this property is their condo, so I'm just going to update it 0.25. The county property taxes. This is going to be always, again, you want this to be locked, so this part is grayed out, but the rate and this one you can change. So for county taxes, it's always going to be under the appraisal value. When you first open this, it's going to be under loan amount, so we have to go and change it to appraisal value, and it's going to be 1.25 of the appraisal value. So again, if you did the loan amount, it's a lower payment. See how this monthly payment gets adjusted depending on what we put. So always want to make sure you do the appraisal value, because that's going to be the higher number, and that monthly payment we need it to be corrected, or need to be correct, so that way our DTI reflects properly. Okay.
Okay, and that's 1.25 of the appraisal value, correct?
Correct. And that's mostly for California properties. For if it's a different state, we do have to figure out what the rate for that state is. But for California's properties, always want to put 1.25 of the appraisal value.
Okay.
This one doesn't need it, but if the LTV was over 80%, we also have to add the mortgage insurance, or if this was an FHA. So you add the mortgage insurance, if you can see it's already on the loan amount, that's fine, but we do have to put in the rate. So if it's FHA, it's always going to be 0.55. If it's a conventional loan, we have to run the rate, so that way this is adjusted properly, because the rate is higher.
Okay.
Okay. So I'm going to go ahead and delete this because we don't need it.
And that's only if it's over, if the LTV is over 80%, or if it's FHA.
Correct.
Okay.
Okay. So this one has two borrowers, but when it's side by side on the first one, it's because they're married. So in this case, it's husband and wife. So that's why we have the borrower and co-borrower. When they're not married, when it's let's say it's a mother and son, or their boyfriend and girlfriend, you have to go to up your borrower, and then you click on this co-borrower, and it opens a new point application. So then here you would put that second borrower's information under borrower one.
Okay.
If the second borrower is also, let's say there's three borrowers. The first one is a single person, and then the other two are husband and wife. So let's say parents with their son. That first one is only going to have this section here by themselves. And then this one, that's the co-borrower, would have borrower one and borrower two filled in, because it'd be husband and wife. So in this case, we don't need that one. So I'm just going to go ahead and update this. We're going to delete co-borrower one, and that way it just deletes this one right here, even though we didn't put anything.
Okay.
Okay. Any questions?
I'm just wondering if we're creating Calyx from ERP, once we import it, the information for the co-borrower one, is it automatically be there, or do we have to manually input it?
No, it has to be manually inputted. And it works the same way with the husband and wife one. Usually the ERP is only going to be inputted for this one, because their application for the co-borrower doesn't have all that information. So we have to manually input this co-borrower. If we're adding co-borrower one, we have to manually input it.
Got it.
Sorry about that. Any other questions?
No, that'll be it.
So for your training, I don't know if you saw the email from Gia regarding the new positions. I think that's what
Yes.
new job position. So you are going to be doing income review. So today I'm going to train you how to review a W-2 income.
Okay.
Okay. So let me see. So let me find a file that has W-2s. So for this one, so when it's a W-2 employee, obviously at the end of the year, you receive this W-2 form from your employer, right? So like all incomes, we do require a full month of pay stub, recent pay stubs. So if they receive biweekly, we need 2 stubs. If they receive it weekly, we need all 4 or 5 week stubs.
Okay.
We'd need both W-2s for 2 years. And depending on the income, we need the year-end pay stub, so that we can calculate. In this case, she receives PTO overtime. So if they receive any commissions, overtime, or bonuses, we need this year-end pay stub so that we can calculate the extra income. So right now we are going to, oh my God, sorry, I don't know why this is this one. Okay, so I'll forward you this income calculation worksheet. So you're going to put the borrower's name. The loan number is going to be blank because it's going to be at the beginning stage before we submit. The employer name, then today's date. So this depends whether they get paid hourly. If they get paid salary, we have a bonus or overtime and commissions. So this is broken down separately, okay? So we're going to be working on just this hourly. So based on the pay stub that she received here, this is the most recent one. It was paid on 8/9. This one was paid on 7/26. So we're going to look at the pay start and end date. So this is the most recent one, okay? So her hourly is $96 with 96.4040 per hour, okay? If you scroll down, not all pay stubs look like this, but this one in particular has it on the bottom. So her regular hours are 39.7. The previous one was 23.66, but she did work, she did get vacation time. So let's see. So 23. So this one shows about 56, 7/8 to 7/21. So that she gets paid biweekly. So she gets, this period was from 7/8 to 21. So that's 2 weeks. She got paid this day, right? And her ended this day. So this one also has over vacation. So 39, 70, about 60. So because her hours are varying and they're not the full 40 hours, I'm gonna go ahead and add these two and then just get the average.
What did you add? I'm sorry.
So right here, we added her regular hours and her vacation hours because it looks like she got paid for vacation and she worked a few hours. Same thing for this one. She worked and she got paid vacations. So as you can see, this one was 56 hours. This check was 63 hours. It's not consistent. I'm going to add the 63.7 plus this 56,243. And then I'm going to divide that by 2. So then I'm going to do her hourly wage times this number, which is up here. So this times 96. 40. So this is what she should be getting monthly, or at least bi-weekly. You can see her total earnings is roughly about that, almost slightly more. Okay.
You multiply it to, I'm sorry, because the screen is small on my end.
I added the 2 weekly hours, so 63.7 and 56.243. I added those and I got 119.943. I divided that by 2. So now using this, so I calculated this monthly income.
And when it's like 59,000, how did you get to 5,781?